Yesterday I was talking about market analysis. Yesterday I was teaching you this in class, and then I told you we have technical analysis, then we have the fundamental analysis, then we have the sentimental analysis. And I told you that I gave you all the definitions, but for the purpose of this class, I'll begin to talk about the technical analysis. This is where we use our charts to make trade decisions. Technical analysis is the study of historical price activities to determine the future price predictions. So when you use your charts, when you open your computer, and you're looking at your candle, you're looking at the historical price activities so that you can make future prediction of the market. That is what we call technical analysis. It's strictly sitting behind your computer to make trade decisions. Currently now I'm on a trade, and I took that trade based on technical analysis. And so it is when you use, and I told you in technical analysis we have the line charts. First of all, we have the bar charts. Then we have the line charts. Then we also have the candlesticks. And for the purpose of this class, our focus will be on the candlesticks. And then I said we have the, this is how the candle looks like. A candlestick looks like this. A candle with this is it has the opening price, then we have the closing price. We have the lower price, then we have the upper price, lower price, and then we have the open price, we have the closing price. And so this from here to here is what we call the body of the candle. This is the body of the candle. Then we have the lower wick, the upper wick. Now when you see when the closing price is above the opening price, the candle is said to be a bullish candle. Yesterday I was talking to you and I was telling you that we have bulls and bears in the market. When the market is buying, it is said to be bullish. When the market is selling, it is said to be a bearish market. So when you see a candle like this, candle can have different body sizes, but it has the body. It must have the upper price, the lower price, and must have body. That's how. But there are certain times that a candle can even be like this without upper wick. All you see is the open price, then we have the closing price. Candle must have a body, must have the opening price and closing price. And so when you see a candle like this where the open price is lower than the closing price, or when we say the closing price is higher than the opening price, is a bullish candle. The reverse is the case when you have a bearish candle. A bearish candle looks like this. Note that I'm using different color. It's the same way we set it on our charts. We use different color to represent the bulls and the bears. So look at it now. In this case now, this is the open price and this is the closing price. The closing price or the close price, then the opening price. So then we have the lower price, then we have the upper price. Then the entirety of this place is called the body of the candle. This is the body of the candle. So a candle is said to be a bearish candle when the closing price is lower than the open price. When the closing price is lower than the opening price. So usually the color is not what matters, but the opening price and the closing price in relative to each other. So when the opening price when the closing price is lower than the open price, it's said to be a bearish candle, bearish candle, bearish candle. And then we have the bullish candle here, bullish candle in this place. So that's how the candles are being formed. Okay, now that will take us to now the market pattern or the chart pattern, showing us the direction of the market. And yesterday too, I was sharing with you that we have four chart patterns or market patterns, and I told you only 3 are tradable, and that's what I'm about to show you now on the board. So now we have market directions or market pattern. Now this is when we have, I told you yesterday when I was in class, and I said, as a retail trader, trend is your friend. And what that means is that for you to make money in the market, you must learn to follow the trend of the market. You are not a market maker, you cannot determine the direction of the market, but when you follow the direction of the market, when you follow where the market is going, that is the only time you are going to make profit in the market. So all the skills that we develop, that we acquire in technical skill, is just how to join the trend, how to jump on a trend and make profits doing so. So we have, and I just show you the bullish candle now. So when the market is going up like this, like this. So when you have, this is high, then this is low, this is high, this is low, this is high, this is low. Okay, HIGH, just like that. And then we have low, LOW, high, low, high, low, high, low. So when you see something like this, when you see high, this high is higher than this high, is called higher high. This high is higher than this high, is called higher high. This low is higher than this low, is called higher low. This low is higher than this low, is called lower low. So when the market is forming series of higher highs and higher lows, it is said to be uptrend. It is a bullish market, or you say bullish market. It's forming higher highs and higher low. It is said to be a bullish market. Therefore, you'll be looking for opportunities. You'll be looking for opportunities to buy. Opportunities, plural. Opportunities to go long, opportunities to buy. So how do you do that? I'm going to be sharing with you subsequently in our class. But I'm going to show you the 3 market patterns, the 3 market directions that are tradable in a market. So when you are seeing higher highs and higher lows, the market is said to be in an uptrend. Therefore, you'll be looking for opportunities to buy. Now, when you see higher high and higher low, there are 2 movements. There are 2 movements in the market. You have what I call impulsive movement. Then you have a pullback. Then you have impulsive movement. You have a pullback. A pullback also means retracement. It also means correction. You have impulsive movement, you have a pullback. Because market does not go like this. No, market doesn't go like that. Market moves, make an impulsive movement, then it retraces or it pulls back. Then it makes an impulsive movement again, then it retraces. Then, or it pulls back. Then it continues on and on until it changes its direction. That is how market moves. And then this is the bullish movement. Then the opposite is the bearish movement. When you see market moving this way, when market is moving this way, is making this is the high, this is the low, this is the high, this is the low, this is high, then this is high, this is low. So when you see the market, so this high, this This high is lower than this high, it's called lower high. This is high, this is high. This high is lower than this high, it's called lower high. This is high, this is high. This high is lower than this high, it's called lower high. Then this is low, this is low. This low is lower than this low, is called lower low. This low is lower than this low, is called lower low. So we have, when the market is forming series of lower high and lower low, it is said to be in a downtrend. It's said to be downtrend. It's said to be a bearish market. A bearish market. And therefore, you'll be looking for opportunities to sell. Opportunities to sell. You'll be looking for opportunity to sell in a kind of market like this. Don't think of buying when you are looking at lower highs and lower lows, lower and lower low. Just think of where do I join the sell? How do I sell in this kind of market? How do I sell in this kind of market? So then we also have the longer side is usually an impulsive movement. Impulsive movement. Then we have a pullback. You have a pullback or retracement or correction. Then we have impulsive movement. You have retracement like this, or pullback or correction is the same thing. Retracement is the same thing as pullback, is the same as correction. So when you see this kind of market like this, it is called a bearish market. Market is selling, and so you always be looking for opportunities to sell. Now, the third category of the market, is the ranging market. A ranging market goes like this. Then you will see that there is a resistance here, then there is a support here. You will see that when the market gets to the resistance, it changes direction. Then it got to the support, it changed direction, got to the resistance again, changed direction. And then you discover the market is moving between a fixed resistance and support. This is what we call resistance. Resistance acts like a ceiling. It's like when the ball is bouncing, it touches the ceiling, then it bounces back. And before it could return back to the ceiling, it must touch the floor. This is called support. It's like this. It's like the floor that supports the further going down of the price. So when you see market like this, when you see price like this, that is moving between a fixed resistance and a fixed support, it is called a ranging market. So what do you do in a ranging market? In a ranging market, you sell at resistance. You will sell at resistance, and then you buy at support. You will sell at resistance, you buy at support. So these are the three tradable markets. That should always be looking out for. Okay, so the third market is not tradable. It's called choppy market. Choppy market. So when you just enter your chart and discover that there's no direction to where the price is going, it's just like consolidating between a small range of price movements. So it is called choppy market. So what do? Just close your computer and walk away from the chart so that you will not lose your money. So we have the uptrend, we have the uptrend. When the market is making series of higher highs and higher low, it is said to be in an uptrend, and therefore you'll be looking for opportunity to buy. Then we have the bearish market. When the market is forming series of lower highs and lower low, it is said to be a bearish market. Therefore, you'll be looking for opportunities to sell. And then when the price is moving between the fixed resistance and fixed support, okay, it's getting to resistance, it's bouncing back, getting to the support, is bouncing up. So it is said to be a ranging market. Another name for ranging market is sideway market. Sideway market. You see that market is moving sideways. It's moving to the side. It's not going up. It's not going down. It's just sideways. So that's the end of this class. I'd like you to quickly do an example for me and identify on your chart these three markets, identify uptrend market, downtrend market, and ranging market from your chart, and send it to my DM on WhatsApp. Send it to the group or to any of the admin on the WhatsApp. Thank you. See you in the next class.